There are a lot of people out there that are talking about how the U.S. is, eventually going to have like the U.S. is the strongest market in the world with the most liquid markets. I do not think there's a lot of merit to this concept that people are going to be able to leave the U.S. en masse. I do think that if you could end up in a situation over time here with freer trade, lower taxes, and deregulation of some kind, like I don't see how those kind of three things aren't really good for stocks. Well, welcome to the Money Alchemist podcast. I'm Brent Gargano.
And I'm Ben Jones.
And we're here today to once again talk a little bit about long-term investing. It seems to continually be a I don't want to say pain point, but a topic of client meetings and what we're hearing from investors in general.
Yeah, everybody's anxious because their capital's evaporating before their eyes. One day it's down, the next day it's up, the next day it's down. Everybody's nervous, walking on pins and needles, wondering, what kind of thing the administration is going to say on the weekend. Who's exempted from tariffs, who's not. There seems to be a lot of confusion around tariffs. One thing that strikes me is that nobody really talks about the actual dollar implication of the tariffs. I know that that's largely because we really don't know what that is.
Who knows? They might just change.
Yeah.
They could be different tomorrow.
But what's funny is that, let's say, okay, with China, like a lot of people think that tariffs in China are a big deal. I think in 2024, we had something like $427 billion in Chinese imports. But you think about it in our economy, it's like $23 trillion. It's not that much.
A couple percent.
You think it would be a lot more because everywhere we look, everything's made in China. But the things that are made in China are these like low cost trinkets and doodads. But it's very it's very salient because it's always in front of us. It's the stuff we use every day. But the fact is, not a lot of dollars come over from China. By far, I think they're our third largest trade partner. By far, the two largest trade partners are Canada and Mexico. But if you think about it in dollar terms, not a lot of money gets sent over to China in exchange for goods relative to like the services we buy. Here's a good example. Think about your annual smartphone bill. How much per year do you spend on smartphones?
A couple $1,000s.
Okay. How much per year do you spend on groceries?
Lots more than a couple $1,000s.
And restaurants. Okay. So tariffs on food aren't as relevant because most of our food is locally sourced. Now, some of it is imported, but most
Canada
of it isn't.
Mexico, right?
So, when you think about these tariffs, people are like running around with their hair on fire because they think that my cost of living is going to go up 245% because that's the tariff we have on China. The reality is, no, not even close to that. But, when you look at the total implications of the tariffs, let's say it's, we'll say on the high side, we'll say it's $500 billion in tariffs, which should be like crazy high. But let's say that's what it is. When you compare that to a $23 trillion economy, it's not that meaningful. Yet we see $750 billion swings daily on the market in reaction to things that don't even have that price tag, the total price tag per year.
But I think there's a point here, which is that people that were fully invested going into this in some ways feel like suckers.
Oh, yeah.
Right? Because they want to be able to buy the dip. And they can't, right? Because if you're fully invested, well, you've got your money in there. Now, we talked in the past episodes about, I believe that you should have kind of a down market playbook and know what are the different things that you can do to maneuver through a down market. But let's say you're fully invested. It's not like you've got this big pile of cash that you're now deploying in the market. So I think there's a lot of people that are feeling like suckers because they were fully invested. And then there's another group of people that for one reason or another, they've got cash. Okay. And there's a couple of reasons they could have that cash. Either they've been saving it over a long period of time, which kind of to the point here, I think is really the true suckers game, because if you look at how the market goes up over time, even today, we're only back to levels from a year ago or so. So if you've been, keeping that cash or saving that cash over a period of years, you feel like you're buying low, but you're actually buying higher than where you could have bought. So point being, there's savers, there's people that maybe you sold a house, maybe you sold a business, maybe you got a bonus, right? There's a lot of reasons that you might end up with this cash in your account. And it's so great that I think that a lot of these people with cash probably feel really good about what the market, like there is a dopamine hit that you get from knowing you're not the one losing money, right? And that you've got this safety while the other person's losing. And that feels great until it doesn't, right? Because markets are fickle and markets move quickly, and generally the best times to buy are also the times where it feels the stupidest. And so I think the point that we really wanted to get to in this podcast is like, okay, like I've taken on many clients in the past where they have like a bucket of cash or a bucket of something that's safer. And they almost say, okay, this is here in case the market goes down so that I could be opportunistic. And that's so easy to say. It's really not easy to do in practice, right? Like buying the market in the midst of a 10 or 20% downturn sounds easy when things are normal. And then you get into the middle of the 10 or 20% drawdown and there's a lot of buts, right? But this time is different. We talked about that last time, right? But there's 8 reasons why it's not the bottom yet. And so I think the concept, we talk a lot about behaviors. And there's a lot of data that shows that some of the best value that an advisor adds is helping drive your behaviors. I think in moments like this, it's really important to be aware of what we call loss aversion, right? Which is an emotional bias of aversion of having losses, and then also have a strategy. And we'll talk a little bit about what we think you should do if you've got cash so that you can make sure you don't miss out on buying the dip.
Yeah, I had this meeting yesterday, and the conversation went something like this. Well, actually, here's how it started, where it was a son looking out for his mother's interest. And the portfolio going into the year was more volatile than the son had cared for it to be. Now, in my professional opinion, it was a balanced allocation. It was performing as it should. And my suggestion was just to hold tight. This is the way things are. Typical boilerplate, financial advisor answer, right? Very boring. Just, be benignly negligent here. But that wasn't good enough. Like action. Some people just they have to do something.
You need to do something.
Yeah, they can't sit idle because, again, that loss aversion, they don't want to be the sucker. They feel like they're going to be a sucker. So here we are in a meeting and we're talking, okay, what do we do now? I scheduled this meeting because after this conversation, my thought was, okay, we need an investment policy statement. Like we can't just be buying and selling because of emotional whims. Like we have to have a clearly defined strategy with, and if you want to be tactical, we need to have a clearly defined catalyst for either a buy or a sell trade. So that's what we met to discuss. And then the conversation just kept revolving around, geopolitical tensions and, these ambiguous stress points and anxieties. The common theme was, I want to get back in the market when tariffs are finalized. It's like, here's the thing, the tariffs are never finalized. You're always going to have trade
and not
tensions.
only that, I heard this. I mean, I took thousands of phone calls at Fidelity. And
Mhm.
I promise you right now, if you're on the phones at Fidelity right now, if you take 20 to 30 calls in a day, 18 to 24 of those are people calling in saying, should I be getting out of the market with my
Mhm.
401k? Like that's absolutely a large piece of the conversations that you're having. And it's so challenging because, you know, you've just met this. I mean, in the case of Fidelity, you've never talked to this person before. They're calling you. They want to talk about selling out, you know, a chunk or maybe their whole retirement account. And this is always what you ask. It is so easy to sell. Okay. Like the emotional comfort that you get of taking your money out of the volatile asset and putting it somewhere safe is big.
Mhm.
Selling's the easy part. The harder part is the buying, and
Well,
you
that- and
have to
that's
get
what I-
both right.
And that's what I was going to get into with this, with this example, because we were having, here we are about a month later, and we have cash that's available because we sold a month ago before the market really became volatile. And now we have this pile of cash, and we got to figure out, okay, do we go back
up
in?
to this point, it has worked.
Yes, it has worked. And by the way,
to this point,
that is a gamble. And by the way, I have another example I'm going to get into after this one. That's more long term. This is happening as we speak now. So here we have the option. Do we get back in the market now at a lower price, or do we hold on? Can you guess what the result was?
I'm going to say that they didn't buy anything, and let's wait for things to look a little better. Huh?
You are correct. So here, all right. So this is a story that's unfolding. Maybe I'll update you later. If we can remember it. But here's another example. This actually involves my mom and my dad, and it goes all the way back to 2008, 2009. And I remember taking the phone call, and my mom was like, "We got to do something. We got to do something." And my mom and dad had equally balanced Roth IRAs. All right, so they each had the same amount of money because they had been contributing to these things. And I couldn't talk my mom off the cliff. She said, I have to do something. And we ended up selling her portfolio. My dad, on the other hand, it's not that he wasn't worried. It's that he just didn't pay as much attention. My mom is the kind of person that she pays attention. She's the kind of person that logs into her account daily and sees things. Okay, how are they doing? Now, she's since gotten better at this, but, I don't know how often she was doing, maybe weekly or so. My dad was so aloof. He probably didn't log into his account but once every 5 years, but he maintained it. He maintained the allocation. Fast forward 5 years later, not only was my dad's account back to its original principal, it was up like 50%
right
from that 2007 high point. My mom was just breaking even.
Yeah, no, I resonate with that story a lot. I mean, if we're going to talk about parents, and I think it's fair. I don't like to talk about clients, but I'll talk about a parent. I think that's fair. So
yeah, it's fair game.
My I was 18 years old in 2008. If that shows my age, I guess. But my mom did the opposite. So I remember it was not fun, and I'm the oldest child, and my parents had recently gotten divorced, and so it was probably not the best or the most fun time in my mom's life. And I was a awkward high schooler, as most of us are. So, I mean, it was kind of a strange time in life, but I remember looking at and hearing about the market volatility, and my mom would always tell me, you have to stay invested. And she had an advisor that she hired at the time. And we talk on this podcast a lot about what makes a good versus a bad advisor. And her advisor admittedly wasn't so great at tax planning and estate planning, but what he was good at was saying you need to stay invested. And I think there's a lot of value in that, because looking back, I mean, I could tell you in my mom's case, there's the difference of her. I've told her this before. The difference of her having to work in her 70s and be retired was that decision, and it's pretty incredible. We talked about this before. Like there are key moments in your life that really define a lot. And you can screw up a lot of stuff in a very short period of time with poor decision making. And by the way, the poor decision making isn't being invested, because over time we actually know that being invested in the stock market is one of the best ways to account for your inflation over like the cost of you buying toothpaste is going to be, toothpaste is going to cost more in 10 years, and the company selling you toothpaste is going to make a margin on that, and their earnings are going to grow, and you need to be invested in those earnings. Otherwise, you're just paying for more expensive toothpaste. And so anyway, it's just so important. And I'm really happy for anybody right now, frankly, that has a big pile of cash and can buy the dip. I hope they came into that cash at some point over the last 12 months, because if they've been sitting on it longer than that, then it's not really a win. It just feels good.
Yes.
But I think for anybody listening who might have cash available, you really ought to consider having a thoughtful strategy on how you're going to get that cash back to work. And one of the biggest, I think everybody, well, I don't want to say everybody, a lot of people are familiar with the concept of dollar cost averaging, right? Dollar cost averaging, most people understand it through kind of the concept of their 401k. I'd like to offer clarification, which is that I think a lot of people hear dollar cost averaging and they think buying in regular intervals, right? I buy every couple of weeks out of my paycheck. I buy every month, but there's actually an extra piece to that. It's buying in regular intervals in fixed dollar amounts. So, hey, I'm going to buy $1,000 worth of stocks every day, whatever. The benefit of that is that fixed dollar amount buys you, if share prices go down, you buy more shares. If share prices go up, you buy less shares. And so if I'm buying, X dollar amount per day, per week, whatever it is, and those prices are going up and down quickly, I can naturally bring my average purchase price down by buying in regular dollar amounts in fixed intervals. Again, because I'm buying more shares at lower prices relative to high prices. And so for me, I think what's really important is look at that stack of cash. Look at, okay, here's how much I am willing to or am capable of investing, and come up with a period of time and basically start to follow and just get the cash in. The idea of loss aversion is that being worried that you're not catching the bottom. Like you may not be catching the bottom. The market may go lower. You might have to watch yourself lose money before you make money. But history would show us that over time, the purchases you're making when the market is down 10, 20% are really good purchases, right? So everybody has different preferences around how badly do they want, what does discretionary mean to you? But if you end up in the situation where you have dry powder, as we would call it, and the markets are down 10% plus, how do you avoid being the sucker that sits on your hands and doesn't get invested and then chases it back up? And I think there are a lot of people that right now, for one reason or another, have ended up with chunks of money that are able to be deployed, put into stocks. And while they know they should be, what I'm seeing is that they're oftentimes kind of frozen with this idea, but it could go down more. But don't you think it is going to go down more? Well, maybe. But does that mean you shouldn't buy?
Yeah. So the important thing to do, I think, when it comes to deploying your lump sum of cash in the market is first understand the purpose of the cash. So I think that if you're going to be using that cash for any reason over the next 36 months, probably shouldn't be investing it. I think you and I both agree on that. The problem I find with a lot of folks who kind of have this buy the dip mentality is that they have this that they have a cash allocation that has a nebulous goal. There's no like spending goal associated with it. It's long-term capital without an allocation strategy. It's just sitting in cash with its fingers crossed.
Yeah, it's long-term capital and short-term investments.
That's right. And the discomfort comes when you are trying to deploy that cash manually. So, and you're either doing it on your own or you've assigned a trigger point to your financial professional. Like sometimes I'll have people ask me, well, Ben, call me when time is right. I say, no, I don't think that's a good idea because I don't, I can't just, when the market collapses in a day, I can't pick up the phone and call you. I might be busy. I might be in meetings all day. And these things happen in such small, narrow time frames that it may just be logistically impossible to connect. So that's one reason I don't like it. The next reason is, let's say I do get a hold of you. That day we have that massive turmoil in markets. Like,
it's not going to be a fun day to buy.
No, it'll be emotionally difficult because there's going to be so much uncertainty, and you're going to be questioning, should I be doing it now? Is now the right time? And then that loss aversion is going to plague your mind, and you're going to ultimately say, I shouldn't be so definitive about it, but it's very likely that you would say, let's hold off. So what you need to do is make it just remove emotions altogether. You need to be very logical about it. You got to be
the first thing you should do, I think, is make sure that your long-term capital is in long-term investments, right? And even if that means that at times those long-term investments look worse than had that money been in cash, I think if you zoom out, you'll find that it's not necessarily worse, right? Kind of back to the person that's got a lot of cash right now just because they've been nebulously saving cash and now all of a sudden the moment is right. Like if you have cash right now, it should, ideally it's because there was some kind of event, a bonus, a sale, something that happened that raised some cash. And now all of a sudden you've got to figure out, how do I deploy that cash?
Yeah, we're talking about cash without a purpose. And what I mean by cash without a purpose is if that cash is not going to be leaving your bank account in 3 years or less, and being spent on some other thing, it does not have a purpose. Now, I'm not talking about emergency funds. So you need to have an emergency fund, which you and I would define as 3 to 6 months of your living expenses. I think that's a pretty good emergency fund.
But 3 to 6 months is based off of your disability insurance. Typically, disability insurance, like if you were to get disabled, disability insurance doesn't kick in for 3 to 6 months typically. So that's where that comes from. The only thing I would add to the 36 months of spending, I would think is that you can be willing to be flexible in your spending. I think when it comes to investing your money, if it's an expense you're going to take on over the next 36 months, and some of those things you can control, some you can't. But if you're going to take it on now, I would encourage people, if you're willing, if you find yourself in this situation where the market's down and there are things that you wanted to spend money on over the next 36 months but aren't that big of a deal to you, maybe you do decide to push them off, if that's possible. And then maybe you do think about investing that money. Like, I think that's a possible conversation. Now, it all depends on, some people would say, well, I don't want to give up. If the answer was, I want to go spend this money on a second home, maybe we're willing to buy the second home in 3 to 5 years.
Yeah, that becomes personal preference at that point. It's all about priorities.
And this is why personal finance is personal, because I think going into those things, like as the advisor, the conversations that we should be having is, how flexible are you to adjust that? If the market happens to be, if we put a financial plan together and I've modeled you buying a second home in 2030, because it's something that you've told me is important to you in 2027. So it's 2 years out. And now we're looking down at that financial plan and markets are down and what have you. How willing are you to push that goal out? And I'm not saying you have to. If we've built a good plan ahead of time, we should have that funded and we should have a plan for it. If you're willing to be flexible, though, all the better, because now we can be more growth oriented with your wealth, and we just have to be more opportunistic as far as when you might buy. So,
assuming you have this pile of cash with no purpose, remove emotion from the decision-making process. Dollar cost averaging is a great way to do it because you automate it. You basically take a lump sum of cash and then you divide it by the amount of buys that you want to do. You can make it whatever frequency that you want. A lot of people do it monthly,
it needs to be a fixed dollar amount.
Exactly.
You should not be saying, okay, I'm going to go buy 10 shares
I'll go
of this.
I'll go a step further. There needs to be a fixed dollar amount and a fixed schedule. So
Sure.
I do not think whenever you insert a manual decision into the process, it gives room for emotion to creep in, and loss aversion comes with that. And that can short circuit the buying decision because you're just trying to catch that low point, which is completely unpredictable. It's like trying to catch 00 on the roulette table. It's very difficult to do, and chances are you're not going to get it right. So you want to have a fixed dollar amount, and you want to do the buying on a fixed schedule. The other route you can go is just, pull the ripcord and just have the whole thing bought at the same time. Most of the time, Brent, dollar cost averaging actually hurts your
Works
long-term.
against you.
Yeah, it works against you. And the reason is because the market, most of the time, I think it's like 51% of the days in the market are positive. So when you're looking at it from raw statistics, the raw numbers, you're better off just
dollar cost averaging makes you feel better, but it generally actually works
correct
against you.
It hurts your long-term results. Now, what you end up with, and you kind of alluded to this, what you end up with if you're doing it right is you end up with not having a pile of cash to buy the dip with. So I read a post on X recently, and it said, my sentiment right now, too low to sell, too poor to buy the dip. And I'm like, that's perfect. That's where you need to be. That means all your capital is deployed according to your financial plan. You need to be, you need to be in a position. And this is what I think what you mean by people feel like a sucker. You feel like a sucker. And by the way, you're not a sucker if this is you. I think that you are actually, you're in a better spot than people who feel temporarily lucky. Because that means that over the past 3-year average, I've been doing plan reviews, and people are so upset, and reasonably so. I can understand. Like I'm empathetic to the fact that my capital seems to be evaporating before my eyes. But people are, I've noticed this, they're mentally locking in the high water mark of their portfolio in February, and they're saying, Ben, I've lost this amount, and that amount's large. But then I say, then I pull back the lens a little bit, and I say, well, let's look at it on a 12-month average. Looks like you're better off than where you were 12 months ago. But that isn't, they're like, oh, okay, but that still doesn't feel good, But the bottom line is that person who sat on the cash waiting for this buying opportunity, they've been better off than you on a year-to-date basis, but you have been better off on a 12-month rolling basis. So, it's all a matter of time perspective. And the fact,
and again, that's all assuming that person with the cash just went and bought.
Yes.
Likelihood is that
They're
person with the cash is sitting on the cash, and the behaviors that led them to have that cash, if it's not there for the right reasons, again, generally going back to those calls at Fidelity, you would ask the people, what's the plan to get back in? And inevitably every time they'd say, I want to get back in when things clear up a little bit. And by the time things have found resolution, the market will be higher.
Well, what do you think that means? What do you think when people say that? What do they mean? Do they mean like when the media settles down, or when their accounts recover? What do you think is the
what does when things? Yeah, I don't know.
I get that I get that response all the time, but nobody can define what that means. It's like, okay, well, tell me more about that, and they can't. It's like they get stuck in a thought trap, where they, it's like they've plunged themselves into a muddy hole with slick sides, and they can't claw out of it, and I almost don't like asking that question anymore, because it's a little pathetic watching people try to claw an explanation out of that hole.
Well,
I can only think that what they mean by that is they want their account to be back to its high water mark. And once it's back to their high watermark, that's when it's okay for them to be investing. So it's like people like investing when things are constantly hitting new all-time highs, which is a little bit counterintuitive, because you would think that people would rather buy at the dips,
Yeah, like I said, the best times to be buying are the times where it feels the stupidest.
Yeah. What does it feel like right now to you? Does it feel stupid to be buying?
I don't know. I mean, markets, it's so much easier to talk about the squiggles. We spend a lot of time looking at financial plans with clients and showing them, these years out in the future. And I actually like in the financial planning software that I use, there's a section where I can look at individual. So the software runs 1,000 trials, good markets, bad markets, all in between.
Mm-hmm.
And you can kind of show the client a projection at average returns or at below average returns or whatever. I can actually get into an individual spot and run a specific trial. So I can go in and look at trial 655, right?
Mm-hmm.
And when you pull the graph on that, it's interesting because you can point at, there's a year in there where their money goes up 30% and a year where their money goes down.
Mm-hmm.
You can point at the volatility. And I really like to do that early on in a relationship because, as we've said before, it's really, really valuable to set expectations early, and getting people used to volatility is one of the most important expectations to set. So it's really easy to look at that on a chart before you have a label as what's going on in that downturn. Now, all of a sudden you have the label,
Mm-hmm.
right? Trump's putting in tariffs. The world's moving away from the US, all of this, I would say not so great news. So I tend to think about markets and whether it's a good time to buy on whether there are more things that we have left to find, right? Because like markets know about what's out there today.
Mm-hmm. Yeah.
Right. So you have to ask a question, are there more things that could be resolved or more issues that could be uncovered? And a year ago, for example, or last, 2024 really altogether, it felt like, the Mag 7 was crushing it. AI spending was big. U.S. economy's pumping. The Fed's not going to be able to drop rates as easily because the economy's tough. I mean, it's like a lot of things were going really right. What is it what could we find that was going to go more right versus what could we find that went wrong? Now it's different. We found the things that were wrong,
Mm-hmm.
right? We found a lot of problems. So now I think we're in a different situation where, like, do we have more problems left to find or do we have more problems left to resolve? And I'm not a bottom caller. I don't try to call bottoms or tops. I think that's a fool's game. But I think, to me right now, it feels like there's a heck of a lot of stuff that could find resolution.
Mm-hmm.
So that doesn't mean we couldn't incrementally find more, we could hear that one of these countries doesn't want to play ball on tariffs and Trump could, there are negative things that could come out, but if I was betting, I would think that a lot of negativity has already been aired. It's going to be a question of how does some of this settle out. And we have this 90-day time frame to negotiate tariffs with I don't know how many countries. I don't know that this is going to resolve itself in like 2 weeks. I think back to market downturns, some downturns last a week. I don't know if this is like a week-long thing. I think we've got to digest a lot of things here. But I do think that underestimating the U.S. and our economy's ability to be resilient is a bad bet.
Well, I'm trying to unpack your answer. I think what you're saying here is that it feels stupid to buy right now. And I would say that would be my response. It feels stupid to buy. Like if you're sitting on a pile of cash, which I actually, I'm closing on my house that I sold recently on Thursday. So by the time this releases, I'll have a pile of cash. And the question will be, should I take that and invest it right now? And I would say if I'm going to be alone in the room with the lights off and just to have that thought weigh on my conscience, my conclusion would be it feels stupid to buy right now. And the reason why, and I can imagine any individual out there with a pile of cash can draw the same conclusion. The reason is because all the uncertainty you mentioned, all these different variables. So there seems to be a lot of change, a lot of things in flux. The tariffs being one of them, but there's also the idea of spending cuts, U.S. government spending cuts, like that kind of has been out of the news recently. You don't hear
DOGE. You have a government budget that's going through. You have tax policy changing. You have the tariff policy. You have uncertainty around.
Oh my gosh,
wars.
yeah. So it feels stupid to buy right now, but that's when I should. Now I can't because the wife has major home improvements planned out. So back to your cash should have a purpose. So we've got a purpose for this pile of cash, or most of it coming in. So the allocation that doesn't have a purpose, I will be investing, even though I have that conclusion that it feels dumb. I'm going to do it because that's when you want to do it. And I'm going to shine some light on this right now. So I think
Enlighten
that
us.
humans, I'm sorry.
Enlighten us.
Yeah. I will. All right. Now this is, all right. I need to have a disclosure. I have no ability to predict the future. All right. So, take this forecasting for what it's worth. It's worth what you're paying for it. Which is free. But I think this is what's probably this is what the next 12 months is going to look like. I think you're going to see a lot of back and forth volatility in the markets in response to the tariff negotiations. I think a lot of this is going to be resolved by midsummer. And I have it's not just the 90-day timeline, which wasn't picked out of the thin air, by the way. It was picked on purpose because Congress needs to shift over to the debt ceiling discussion. And then also that's the time that they need to talk the TCJA sunset. For those who don't know what that is, that's the Tax Cuts and Jobs Act, which was passed under reconciliation in 2017. That is sunsetting this year. That needs to be addressed in order for it to be extended. If it is not, every American, well, most Americans, a small sliver wouldn't get a tax increase. Every American would get a pretty large tax increase, federal tax increase next year. So you combine that with tariffs and, and then just the point we are in the economic cycle, that's a recipe for recession. You cannot go into that in a midterm election year. That's just simply not politically viable. So there's a lot of incentive for the administration to settle on trade by midsummer. Now, there's one exception to this. I don't think that the deal with China is going to be settled. I believe that the tariffs that are on China are structurally different than the rest of our trade partners. It is my belief. Now, this is where speculation comes in. It is my belief that I think that there's bipartisan support, and that bipartisan support is backed by corporate America, that they're just sick and tired of Chinese anti-trade policies. So I think that no matter what shifts that we have in the political winds in Washington, I think that the tariffs that we see.
Yeah, the Democrats have wanted tariffs on China for decades.
Yeah, I think that the trade relations between the U.S. and China are never going to be what they were.
Well, admittedly, I think that started in COVID.
Yeah, absolutely.
I mean, there was a lot of talking. I mean, really this deglobalization. I mean, for decades, I mean, when I was a kid and I was plugged into the politics, Republicans got up and talked about how globalization drove down costs and inflation and increased profits and was good for business. The Democrats were the ones that said we need to do tariffs because U.S. workers now, we've got these and I don't think I think there are actually a good amount of Democrats that are behind tariffs on China.
Yeah. That's what I mean. I sense bipartisan support here.
I think the rub, and we'll have to see. I mean, hopefully we've all got our fingers crossed that it works. I would hope, unless you don't love America. And, I mean, I don't care your political affiliation. You got to hope this works. But I think the beef that a lot of people have is like, gosh, do you want to take all this on at once? Would it be a little bit more effective to go at a couple of individual deals and establish some deals so that you can have some weight behind you as you go address these others? I mean, we'll have to. I mean, I don't know if anybody besides Trump really knows exactly the plan, but
and he may not even know the plan himself. They've obviously done a terrible job at communicating the strategy. And this goes into my prediction. So, you've got all this happening right now. I think the negotiations with China, so to speak, are intentionally sabotaged. I don't think there's any real negotiation with China other than we're done. I think that's the negotiation with China. I think that the intent is to friendshore all that manufacturing, bring it over into the U.S. or at least U.S. allies. But the majority of the trade that U.S. has, I think that those trade deals get settled by midsummer. And I think we shift gears. I think we easily pass the debt ceiling issue, and then we have an extension of the TCJA. And because of the living hell that retirees have been through with this volatility, I will tell you, I've had a lot of conversations with clients who are retired, and they are just on pins and needles. They absolutely hate this volatility and the uncertainty. And I think going into the midterm year, you need to, if you want that voting base, you need to extend an olive branch, and they're going to do that with. We mentioned it in the tax podcast. What did we say about Social Security?
No tax on Social Security.
No tax on Social Security. You watch. That'll happen. That's the olive branch that's going to be extended. And then we'll say 8 months from now, everybody's going to forget about this. And we're going to have continued deficit spending. We're going to have the trade deals behind us and all that volatility. We're going to have an extension of the TCJA. And then we're going to see a resurgence of the AI craze, because AI hasn't gone away. It's actually continued to advance. We had, we got Grok 3.0 or Grok, what is that, 3.0? And then we got Chat GPT.
Some of the most important companies in our civilization as humans are U.S.-based companies. You do not want to bet against the U.S. at this point in time. There
Absolutely
are a lot
not.
of people out there that are talking about how the U.S. is, eventually going to have like the U.S. is the strongest market in the world with the most liquid markets. I do not think there's a lot of merit to this concept that people are going to be able to leave the U.S. in mass. I do think that if you could end up in a situation over time here with freer trade, lower taxes, and deregulation of some kind, like I don't see how those kind of three things aren't really good for stocks. So we'll have to see how it all turns out. But I think the goal, again, would be lower taxes, freer trade, and deregulation. Right now, there's just too much uncertainty, and I think everybody is this idea of loss aversion. Everybody's afraid to make the first move and get burned.
Yeah, and that's why it feels so stupid to deploy cash in this market, because of all the uncertainty. But as I just laid out my forecast, and again, full disclosure, take it for what it's worth. And I really think now's a great time to be bullish on U.S. equities. And that is contrary to everything that I'm seeing on X. All the stuff that I'm consuming, all this media that I'm consuming seems to be to the minute market commentary, and it's not long-term focused. And none of it seems positive. It all seems like, hyperbole and, blood in the streets, and everything's doom and gloom. At least that's the takeaway I get. I'm sure there's positive things sprinkled into this market commentary, but the general feeling I get after consuming this is after I turn everything off and I start thinking about it, I'm like, man, it just feels like I'm not optimistic. I just feel very depressed about, the overall direction of the economy. And the reality is, like, it's likely completely the opposite.
Well, we will see. But yeah. I go back to, I'll end on this. In my Fidelity days, like I said, when of the 20 phone calls you took in a day, 16 of them were people getting nervous about markets and trying to figure out how to get out. That is not the moment to sell. You should not be, the moment to sell, if there was a moment to sell, raise cash, is when you have the opposite. When everybody is calling you, when half or more of your phone calls are people calling in saying, why has my diversified portfolio not performed as well as the S&P 500? Get me in the S&P 500 because I want to own more of that. That's when you be nervous. You don't want to be nervous when 3/4 of the people that are talking to you about investments are freaked out and trying to get out, right? Warren Buffett always said, buy when others are fearful. And
why do you think Berkshire Hathaway is sitting on the mountain of cash that they are?
Well, I think they've been sitting on that cash for a while. That news story has been out for 2 years. So it's no secret that Warren Buffett's been building up building up cash. He's also been invested. So I don't think it tells the whole story. I mean, he does have plenty of money invested, but clearly, he's gotten so old. Charlie Munger's passed away. He's trying to pass things to this new guy. I mean, I would not bet against Berkshire, but I don't know if it's Warren's just not, got as many deals that he likes or whatnot. But I don't think Warren's afraid to sit on cash. Let me be clear. Warren Buffett is not the same as like an average investor. Okay. When markets get dislocated, like he gets phone calls from CEO. Like he famously made an investment in Bank of America in 2008 because they basically called him for a bailout, and he got amazing terms on like a whole bunch of options and all of this other stuff, right? Like you as an individual investor are not bailing out Bank of America, okay? And you are not going to get the kind of creative deals and terms that Warren and Berkshire may be able to get if things get really dicey. So I think trying to, while it's great, and I don't, not necessarily a recommendation, but I think Berkshire stock has done really well over time. I don't think that means that you should be managing your portfolio pretending to be Warren Buffett. Even Warren Buffett himself has said that when he passes away, he hopes his wife would just buy an S&P 500 index fund. I really don't think comparing yourself to Warren Buffett is an apples to apples comparison. Now, owning Berkshire, go ahead.
Yeah, I've always liked what Warren Buffett and Charlie Munger's investment strategy. I do read the people's comments on the cash, and everybody's thinking like, oh, Warren Buffett looks like an all-star right now. Everybody's praising him for, basically seeing the future. I'm not so sure that he saw the future. I just think that in this market, the stocks that have done the best are the ones that he's historically been averse to, technology stocks. Remember how long it took him to make an investment in Apple?
Oh, gosh.
Yeah, it took him forever. He loves these, blue chips, companies like Coca-Cola, Costco. He's Berkshire's famous for, taking companies like NetJets as one of their best examples. They take a private company and they keep it private, and they just basically, turn it into a gold machine. But, I think that the companies to the size now where they just have so much capital, it's tough to find good deals that provide a return on equity in excess of, cash rates that fit the mold that Warren Buffett likes, which is that traditional like blue chip, cash cow kind of company. A lot of the companies that seem to be super popular and generating a tremendous amount of earnings right now are these AI related companies. And AI is so new, kind of like the internet. It's like trying to figure out what companies are going to win the internet. You remember, you probably don't remember this, but in the late 90s, you had companies like Cisco just take off like a rocket. And ends up today that, Cisco wasn't the company. In fact, they didn't own the internet. And who's heard of AOL? Who uses AOL to this day? AOL is kind of a shadow of its former self. So there's just a lot of unknowns around AI. So it makes sense for a large company that can't really deploy capital in like microscopic ways. It needs to, it needs big monstrous deals to generate a good ROE or ROI. I'm sorry. It would make sense for them to kind of sit on cash and look for opportunities, look for the winners in the new economy. So that's my theory behind Berkshire and why they're sitting on a record amount of cash. Anyway, I'm not an individual equity analyst. That's just me that's my
just buy Berkshire.
There you go.
Right.
And leave it alone.
Don't try to become your own Berkshire.
Don't
just
get cute. Yeah.
Right. Well, I think the point that we're making here, and let's wrap this up for everybody, because I know they've been listening for a while. So, I think it's really important that if you feel like a sucker because you've been fully invested and now the market is down, do not feel like a sucker. I could give you, we see it. I could give you lots of other situations with people that are less invested that maybe can look at you right now and say, hey, I've got money to buy stocks with. But that is different than actually buying stocks, and that doesn't tell you what their actual return has been. Right now, it feels better to have been sitting in cash watching the market goes down. It is not actually better until you buy the market. So don't feel like a sucker. If you are one of the people that happens to have cash on hand for one reason or another, please, whether you talk to an advisor, whether you do it yourself, but come up with a plan and a strategy that you can stick to so that if that money should be invested, it gets invested. And whether the market goes down a little bit more between here and when you make gains, that's, my crystal ball is as broken as yours. Time and time again, as advisors, we see this. The clients that are the wealthiest have been the most invested over the longest periods of time and have stuck with it. There's no question when we look at client accounts.
Yeah, you're just basically saying be aware of loss aversion. Well, I appreciate everybody listening, and we look forward to catching you next time. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Any company names noted herein are for educational purposes only and not an indication of trading intent or a solicitation of their products or services. Advisors associated with National Wealth Management Group may be either 1. Registered representatives with and securities offered through LPL Financial, member FINRA SIPC, and investment advisor representatives of National Wealth Management Group. Or 2. Solely investment advisor representatives of National Wealth Management Group and not affiliated with LPL Financial. Investment advice offered through National Wealth Management Group, a registered investment advisor and separate entity from LPL Financial.